Today we're going to review the dollar index from a macro perspective and discuss the key levels that could shape the next major move. We'll start by looking at the higher time frames and work our way down to see how price has been reacting with remarkable precision. On the left, we have the 12-month time frame. On the right, we have the 6-month time frame. Let's begin with the 12-month chart. The first level I want to highlight is level A. Look at candle A2. Notice where the low formed. It respected the open price of candle A1 almost perfectly. This is the kind of relationship that often gets overlooked because most traders never zoom out far enough to see it. Now let's look at the second significant level, level B. Again, notice the precision. The low of candle B2 respected the open price of candle B1. Two major reactions. Two precise references. This gives us important information about how price is interacting with these higher time frame levels. So that's the downside structure. Now let's shift our attention to the upside. There are three key levels I want you to focus on: C, D, and E. Remember, these are levels derived from 12-month candles, which means they carry significant weight. Price has already traded through levels C and D. That naturally brings our attention to level E as the next major upside objective. What's especially interesting is how price reacted when it reached levels C and D. To understand that, we need to drop down to a lower time frame. Now we're looking at the 6-month chart. Take a look at the candle high marked in blue. Notice how price reacted as it reached level D. Even though the candle slightly overshot the level, the reaction occurred exactly where we would expect it to. This is an important lesson. A level doesn't have to produce a perfect tick-for-tick reversal to be respected. The reaction itself is what matters. Now let's go one step lower and move to the 3-month time frame shown on the left. Pause the video for a moment. Study the chart carefully and see how many of these higher time frame levels you can identify. Pay attention to how price behaves as it reaches each one. You may start noticing something that isn't obvious at first glance. Let's examine a few more examples. The first is level F, marked in yellow. Look at how candle F2 reacted to candle F1. The precision is difficult to ignore. Price reached the level, reacted, and reversed. When you see this happen repeatedly across multiple time frames, it becomes increasingly difficult to dismiss as coincidence. Finally, let's look at level G. Notice how G2 turned exactly at the low of candle G1. Once again, the reaction occurred at a precise reference point. No broad zones. No arbitrary areas. Just a specific level and a specific reaction. And that's the main takeaway from today's analysis. When you study the market from a macro perspective, you begin to see that price is often responding to highly precise levels hidden within higher time frame structures. The more time you spend studying these relationships, the easier it becomes to anticipate where significant reactions may occur in the future. I hope you found this analysis useful. If you did, make sure to like the video and subscribe for more multi-time frame price action studies. Thanks for watching, and I'll see you in the next one.